Good morning, folks. So, this will be an interesting episode of Back to the Futures with me, Marcus, and Mayhem. We've got some geopolitical escalation playing out in the Middle East with the US Israel Iran war and how that is spreading throughout the region and also amplifying volatility, something we'll be paying careful attention to. And it's interesting how these things sometimes do correlate to seasonality. I mean, this is actually the time of year where volatility tends to do pretty darn well up until mid-March. And there's actually some structural reasons for why that happens. So we'll be discussing that as well in some of our charts. So stay tuned, just getting everything fired up here. So first and foremost, risk management. That is really the most important part of the game. If you're going to stay alive as a trader or as an investor, you've got to manage your risk first and foremost. I talk about this every week because it's that important. Most traders fail. A lot of investors fail as well. And the primary reason that they do not succeed is that they're not managing their risk. Now, one simple rule of thumb is size your positions based on their inherent volatility with the goal of not having a drawdown greater than 1 or 2% of your total portfolio liquidity. The math behind that is assuming that you can look at a combination of realized and implied volatility for an instrument, determine where outside of that range it's moving too much in the wrong direction, place your stop under that percentage, and then calculate that loss such that it's not more than 1 to 2% of your position when sizing. Now that you've thought about doing that, you've given yourself a lot more chances to trade the market. What I've seen is many people tend to simply go all in and hope that this is going to be the one. It's sort of like putting it all on black. Don't be that person. If you're lucky, you'll actually be unlucky, as strange as this sounds. If you're lucky enough to win a concentrated bet, and it's not because of discipline or strategy, which it wouldn't sound like it would be in this scenario anyway, you may set yourself up for the other psychological folly of trading, which is the Midas touch folly. The idea that, hey, I'm so good at this, anything I touch goes up. So I'll just, sort of wing it and buy whatever I think I can buy. That'll go up because I got lucky. A lot of people that do that, they get that mentality and then they blow up. And that humbling is sometimes what helps folks to turn it around. I mean, a lot of folks on this journey blow a few accounts before they finally get their consistency down if they continue. It is a gauntlet. You should set your expectations realistically. You don't want to learn about the fourth shape. And it comes down to the math. It's a lot harder to regain capital once you've lost it, especially once you get past 20%. The math just becomes less and less forgiving for rebuilding that capital. And it's certainly not going to happen through a revenge trade. That's one of the worst things you can possibly do to yourself as a trader. When something doesn't go your way, the best thing you can possibly do is close out of that, look for other opportunities, and don't look in that rearview mirror. If it does what you thought it was going to do, maybe that just means you need to adjust your entry and risk management parameters. Like, for example, if you got stopped out because it went a little lower than you thought, maybe what you really needed is a smaller size position with a wider stop. Think about it. Journal your trading so that when you're reviewing your trades, ideally once a week on a Friday or over the weekend, you can go back and say, you know what? I would have been right if I had done a few things differently. And then you can look at how you might be able to change your system. It's not going to work for everything. Some things we're just going to get wrong. Some of the best traders only have like a 60% hit rate. But if those 60% hits are running and you're letting them win, and those losers are small and you're chopping them when it's appropriate to do so, you're going to be making good money. Taking ego out of the game is so important too. I can't tell you how many folks struggle with the idea of cutting risk at their stop rather than moving it lower. Because, there's this idea that, oh, but I'm right, and I don't want to admit I'm wrong, and by selling or closing this position, I'm admitting I'm wrong. That doesn't matter. Who cares if you're right or you're wrong? It's about making money. We're all going to be right and wrong in the market. Let's talk a little bit about my experience. I've been doing this since 2005. That dates me a little bit. 21 years of trading markets, of working with fund managers, of investing my own capital, of building trading tools. It's really been quite an exceptionally fun journey. I've learned a lot. I've met a lot of amazing people, and I'm fortunate enough to be in a position now where I can pay a lot of that forward. That's why I love doing these once a week streams, and I'm planning to add some more content that I'm going to be putting out there, both video and written. I've just launched a free Substack to share more of my insights about what's going on in the market. And I post a whole lot of content on social media as well. All of that is really to try to help my audience level up. I know there's a lot of noise out there. I try to focus on the signal. I suggest you do the same. There's only so many hours in the day. If you find there are bits of information that don't help you make informed trading decisions, take them off your charts, take them off your market prep, take it out of your mind. Focus on the signal. That's one of the most important parts outside of risk management, is not getting analysis paralysis. If you've got too many lines on your chart, if you've got too many things you're monitoring, too many positions in your portfolio, etc., that can degrade your ability to execute. You've got to focus on what works for you, and that should also be part of your trading journal. How did you come to this decision? What did you analyze? What did you find was helpful and not helpful in review? Because we can all build a trading strategy, and we should, but if we don't practice it, if we don't adhere to it, if we don't actually build it over time through that idea of journaling and iteratively improving it, then the trading strategy might look really good in theory, but in practice, it could be total trash. That's why it's really important to, again, step aside from ego. Maybe the strategy's first draft wasn't that great. Maybe by the time it gets to its fifth iteration, it will be solid. The only way to know that is if we're willing to objectively assess strengths and weaknesses. So let's zoom out, looking at the big picture of what's going on in these markets. First, we're hearing about the Strait of Hormuz being effectively closed, and that means a fair amount of oil heading to various Asian destinations and parts of Europe is now being rerouted. It's not that it's blocked off, it's that it's taking a more expensive route, a longer route. That means that oil tankers are going to have much higher fees. It means that gets passed on to the end customer in higher oil prices and delayed shipments. This has put a premium, a geopolitical risk premium on oil, which is bid up this morning as well. We've got Brent now above 80, 83.48. We've got West Texas Intermediate crude also bid up to 76.13. And what would an energy market rally be without natural gas up 5.81%? So you can see there is some of this bleeding into the energy markets over the last several days. Yesterday, oil had that big move higher, settled off its highs. Now we're actually breaking above yesterday's highs in both West Texas Intermediate and Brent. So there is a real bid behind this. And in terms of Iran's oil, who's the biggest buyer? It's China, similar to Venezuela's oil. Noticing a bit of a pattern here. Nevertheless, it's going to be important to watch how this situation resolves, because ultimately it's becoming more of a potential regional war that could last quite a while. That could have episodic effects on oil. It could have impacts on the regional economy. And of course, Sadly, it is beneficial to a number of defense contractors in Israel and in the United States, but we're here to make money, and there's certainly a bid to be had in some of those plays. And some of the drone plays had a really big bid yesterday as well. That may continue if we see these tensions escalate. Now, shifting gears a little bit to liquidity. This is where we are right now in the SPX flow of funds. You can see we are in the liquidity low zone. That is to say, early March, these first 2 weeks tend to be tumultuous anyway. Take war out of the equation, take anything else out that are known risks, and it's just a time where the market tends to be more volatile, where you're more likely to see drawdowns, where you can break ranges to the downside, hint, hint, and where price discovery starts to get a little bit reinvigorated. And the reason is in two parts. For one, it is liquidity runs low, and then by mid-March, it starts to ramp right back up again. So this could provide a decent buying opportunity for swing trades and investments. It's a good time to make a shopping list when the markets are under pressure. The other part of it, and it's probably related, is the seasonality of volatility really improves here into mid-March as well. So you've got liquidity drying up, you've got volatility mechanically ratcheting higher, and that does set us up for some discounts, especially in some of the higher beta parts of the market. So I think it is a good time to make a shopping list. I think it's a little early to do too much buying, but I do like the idea of looking, and we'll go to the chart soon, but looking for a breakdown from this range we've been trading in as an opportunity to load up some equity longs, both here and abroad. Speaking of equity longs, this has actually been one of the most interesting times of dispersion. You've got stocks within the S&P trading with the least correlation to the index that we've seen since the great financial crisis. I just wrote an article about this on my Substack, talked about how this is a stock picker's market because of this, and it very much is. Now, whether this trend continues is a whole other matter altogether, but as long as this spread is elevated, you're going to have both a stock picker's market and a real hedge funds market. That is to say, the real long short strategies that are looking for buying relative strength and selling relative weakness can also do really well in this environment of elevated dispersion. And in terms of relative strength and relative weakness, we can see it playing out on this chart from Goldman Sachs. Asset-heavy companies outperforming asset-light companies. That really does tell you value is outperforming growth. That's a big part of this because the asset-light companies are often the more tech-oriented companies, the ones with more intangible value built on things like intellectual property. The asset-heavy companies, they're going to be the ones that are more like your industrials, materials, miners, energy companies, etc. And certainly those have been outperforming, and that may continue. Meanwhile, in tech, we've seen a drawdown across positioning aggregates, which tells you we're no longer stretched long tech. That's a good thing, by the way, because that could also set us up for some opportunities to buy some of the heavyweights in tech. I'm still looking for more dips to add to my Google position. It's a big position, but I'd always like to own more at better prices, for example. Now, zooming out to the global picture, when tech underperforms globally, emerging markets tend to outperform globally. So we are in that potential handoff right now. We have seen tech underperforming since November of last year. Emerging markets have had a strong outperformance last year, and this year they've had one of their best starts to a year in 30 years. The momentum is there, the relative strength is there, and it could be set to continue. Another area of opportunity is cyclicals versus defensives. If you take Goldman's economic forecast, which is looking for GDP in excess of 2.5%, that suggests cyclicals should run versus defensives. So again, think about things like financials, energy, materials, industrials. There are signs that if the economy starts to climb back up out of that fourth quarter doldrum, we could see pretty significant outperformance in cyclicals, both here in the US and abroad. Now, the risk for emerging markets is actually playing out. This is that if the dollar appreciates, emerging markets suffer. If the dollar depreciates, emerging markets tend to rally pretty hard. We are seeing an appreciation in the dollar, which I'm looking for it to set us up an opportunity to buy some of these emerging markets at lower prices. And we'll talk about that in a later chart looking at the dollar technicals. But suffice it to say, I don't think that dollar strength is going to be a long-term phenomenon. When we're looking at this chart of global emerging markets relative to the United States market, we can see this might be just the beginning of a much bigger move. If it's anything like prior moves, we could have quite a bit of room for global emerging markets to outperform the US. And that's great. It would give us an opportunity to extract some value from places that are much more reasonably priced, where the valuations suggest the downside risks could be quite a bit lower. So I'm all for it. I'll take, momentum and the opportunity to make money in whatever asset class in whatever region it presents itself. And right now, the markets are very clearly telling us that's overseas. We just need to wait for the dollar strength to settle out. And finally, a quick note on AI. If you've been following my work, you know that I believe that over the last year, the narrative has switched from one of sheer scale to one of efficiency. That is to say, it's not about just having incredible amounts of compute to win the AI race. If it was, companies like XAI would have won the race because they have arguably some of the largest scale, and yet they have some of the least powerful models. On the other side of it, look at Google and what they've accomplished. Google has the whole AI hardware stack. They built the TPUs. Those are the compute units that inference runs on. They have their own inference engine. They have their own customized version of Linux that inference engine runs on top of their TPUs. And they build their own models. So Google has the whole AI hardware stack, which is one reason they've been able to extract so much revenue per gigawatt. I like this metric, by the way. I was never a fan of measuring compute by gigawatts because it's completely arbitrary. But the idea of showing revenue per gigawatt or operating profit per gigawatt or even compute per gigawatt, that adds a lot more value to that metric. And Google and Anthropic both leading on this chart in terms of sales and earnings respectively. Let's shift over, talk a little bit about the technicals. I can't say I love them, but I am happy about the idea of potentially being able to buy things at lower prices. So there's something to look forward to, silver lining, if you will. The S&P is showing vulnerability as it trades at the lower end of this range. In fact, it's breaking below the lower end of this range this morning. If it closes the week out like this, I think it's very likely we retest those November lows. That would bring us down to about 65.25 on the S&P futures March contract. That would not be a bad place to start looking at adding risk, in my opinion. I do think that this market is wobbly here. We've got a pattern that looks very distributive over the last several months. So you can see underneath the surface, there's been this rotation into safer parts of the market, into some of the more asset-heavy parts of the market. But it has been a rotation out of tech, and tech is such a large part of the weighting in these indices that they can't really run without it. Look at 2022, for example. The mega weight components of the indices really brought things down. There were other parts of the market like energy that were rallying. If you looked at the indices, you wouldn't know that because energy is an inconsequentially small part of the total index weighting. Well, we have a sort of similar situation happening here. It's not quite as drastic as 2022, but there certainly is a rotation out of tech. There's other parts of the market that are performing, but they can't really make up for that weakness in tech. And so it does feel like as long as tech is heavy, we do have that risk to the downside in the S&P and also, of course, in the Nasdaq, which could take us back to last summer's lows if we break the lower side of this range, which I think is increasingly likely. It's not just the geopolitical tensions. It's also the generative AI CapEx growth narrative, which is coming under some pressure. We heard on February 20th, OpenAI was downsizing their AI CapEx plan significantly. I would not be too surprised to see other companies go through similar discussions about how they may slow down their build. They may push out their goalposts to years ahead, or they may just slash CapEx spend. And by the way, that's not a bad thing. If we look at what's happening in AI overall, it is efficiency that is increasing. You're seeing smaller models being able to do more, like Alibaba's Qwen, a 9 billion parameter model that can hold its weight with GPT 120B, a 120 billion parameter model. It's a model that's like 93% smaller, and it's still pretty similarly capable. Obviously, we're comparing mixture of experts models with dense models. It's a variation in the architecture behind these large language models. But at the end of the day, if you can take a model that's about the size of putting it on a phone or an old video card and run with a level of inference quality that you couldn't previously achieve, that's a major milestone. And that progress continues to accelerate. So it's something to keep an eye on, because it's no longer a race to scale. The new gold standard in AI is density of intelligence. Speaking of gold, gold behaving with its upward trending channel here, once again getting to the top and being rejected. I think ultimately we're going to break out of this channel to the upside and start to build some new structure above it. But apparently it wasn't going to be this particular escalation that led us there. Now, it's also interesting to see gold and silver down so heavily this morning, given that geopolitical tensions are typically good for precious metals. But I suspect there is some deleveraging going on underneath the surface. That is to say, if you're leveraged in this market and you've got a bunch of different stuff that you can sell, you may just sell whatever you can. Gold and silver tend to be those things in the portfolio that when things get tough, when someone's tech positions are going against them or whatever else, they sell some of that as well. So I think there is some deleveraging going on in gold and silver as a part of why we're seeing some of this weakness. Silver is hanging in the balance here. If we do crack this lower trend line, then I think this whole upward move from December on is in big trouble. So it's going to be pretty important that we don't break back below this line. This is sort of the line in the sand for the silver bulls. And I know there's been a lot of talk about COMEX not being able to deliver inventory and all this other stuff. I've been hearing this talk for on and off 2 decades in the precious metals markets, and it doesn't typically on its own present a bull case. We need to see real industrial demand for silver, real precious metals demand for silver and gold to really bring them back to life. And gold looks a lot healthier compared to silver here. Gold's uptrend is completely fine. One of the things that I said going into Feb is I thought silver would underperform gold, and it would take some time to digest these gains, and eventually we would start to push higher, but it could take weeks or months. I'm still of that mind here, and if we break this lower trend line, we could go into a long-term consolidation pattern. Sort of shake out everyone, not just due to downside, but due to boredom. Bitcoin also looks quite vulnerable to me. In fact, I still wouldn't be surprised to see Bitcoin get back to about 52,787. The way it's trading, lower highs, lower lows, accepting these lower lows, gives me a sense that it's still heavy. Liquidity is also low in this market. Bitcoin is a relief valve for excess speculative liquidity. So this also gives me a sense that, we still have a lot to parse through in terms of what's going on with Bitcoin to try to put in any kind of durable low. We would need to see bank reserves build back up. We need to see reverse repos build back up. We need to see short-term and intermediate-term liquidity in the global financial system meaningfully build before crypto can catch much of a bid here. And here's the US dollar index. We've been talking about this chart for a long time, that we could probably get a little bit of a bounce here, that it would put pressure on precious metals, that it would put pressure on emerging markets, and that it could give us a bounce that surprises a lot of people, shakes people out of their positions, but ultimately presents a buying opportunity. Because I think the dollar can still ultimately resolve meaningfully lower because of accelerating de-dollarization trends, aggressive deficit spending, and some of the other things we're talking about and we've been seeing. The outlier is Warsh and what he actually does and what he actually means. Last night I was reading some headlines about how he wants to do QE to a point to reduce the Fed's balance sheet down to pre-great financial crisis levels. It probably has the markets a little upset hearing that the next Fed chair wants to do a very aggressive quantitative tightening, because that would be pretty bad for almost all the assets out there. So we'll see if that comes to fruition. I don't think he's going to have that flexibility, because I don't think there's enough liquidity to drain the balance sheet much further than they have. In terms of this week's pivots, I've got this all on screen for you. I'm going to take a screenshot of this as well and share it on social. So I'll put this out on X if you all want to check it out there. And we can see we're pretty much below those pivots on everything. Yeah. Gold, silver, Nasdaq, S&P, we're below those pivots on everything. So we are in bearish territory. And that's for swing trades. It's also for intraday. Yesterday, we could see 6810.25 was a huge line in the sand. The market fought to hold it. We rallied back up, made a pretty decent rally off the lows, but today we're giving all that back and then some. Now let's quickly look at what's going on in the SPX options levels. You all are welcome to screenshot this and share it. This is from my SPX options visualizer. It goes through, looks at all of the options, the S&P 500 options chain, breaks that information out, and it is queryable via a Discord bot that I've created, but also can be mapped onto Bookmap, MotiveWave, and other charting software. And one thing I always like to say, no matter where you are in your investing or trading journey, no matter whether you're doing well or poorly here, it is all a cycle. Don't give up. Learn from your mistakes. We all pay a tuition to the market. It's up to us as students to learn the lessons being taught. If you're having a rough go right now, learn about why. Did you size up too much? Are you running leverage? Are you too aggressive in options positioning? Think about it. Don't just quit. Think about what didn't work out and why it didn't work out so you can do better in the future. That's the way. And we've got some awesome deals for y'all. If you're interested, you can get up to 20% off of Trader Aid plans using the code Mayhem20 at checkout, and up to 40% off of Bookmap. Just go to traderaid.com/bookmap and scroll down to the special offers. So with all that being said, we are going to dive right into Bookmap ahead of the market open. It's got about 1 minute and 10 seconds left. And that headline just crossing that Trump says the United States has enough weapons to fight wars forever. Well, hopefully it doesn't come to anything like that, because I could do with a whole lot more peace than war personally. $30 to the market open. Good morning, Loki. Good morning, Peg. Yeah, Peg, that's what you would want to do. You would want to look at futures for Forex if you wanted to trade like GBP or other things like that. And those futures are actually super liquid, so Bookmap can be quite helpful for mapping out those trades as well. We are getting a pop off the open here. And inside the market, pretty universally red. Not seeing the same flight to defensives that we've seen previously. In fact, it's actually rather odd. You've got a bid for software, a bid for energy, a bid for some of the telecoms, which are marginally defensive, but that's about it. Almost universally red across the heat map. 81% decliners versus 11.2% advancers in this market. Fair amount of buy-side volume coming in here in this last 5 minutes. And we seem to be bottoming out just around key 4, the pre-market level, just around 910, 915. We got that hit down at key 4 negative. That's a large level of negative gamma or put-driven gamma exposure, so it does often act as an area of support. And we certainly saw that this morning so far. And we're going to zoom in just a little bit more. One of the cool things about Bookmap is being able to zoom in so far into what's happening, into the heat map, into the microstructure that's being built. It's pretty cool, especially when the market's really liquid like open and close. All right. Seeing a little bit of a grind lower off that opening pop. Suspect the Nasdaq looks similar. Yeah, we've got a nice pop and now giving a chunk of that back. Good morning, Jan. Now prices breaking below the BGL or the 5-minute 21 EMA. That is an important momentum indicator that I like watching. Think that's one of the more important momentum indicators to watch during the trading day. It's really simple too. It really is just a 5-minute period, 21 EMA. Throw that on the chart. And there was some seller absorption down here as well on the Nasdaq. S&P also bouncing off of its lows here, challenging the point of control from below. Point of control tends to be a pretty good line in the sand to watch as well. I mean, the name, as it suggests, really who's in control. Above suggests buyers are taking control. Getting a nice pop on that break above the point of control as well. And if you were to zoom out and look at the pattern that we have from, say, the European Open to now, it does look like we're trying to put a bottom in here around key 4 negative. Has that look about it. I'll see if I can find another chart to show that. Yeah, so sort of what we're seeing here in this chart made a decisive new low, but this now looks like a higher low, and we're trying to make that push. The next level I'd be watching for overhead would be this area of offered liquidity around 6,800. If we can make a decisive push through that, that's going to suggest that buyers have the demand to start challenging some of these higher levels. We have yesterday's put wall above. That could be a reaction zone as well. And we'll start to see some of that liquidity coming in from the CBOE trading of SPX in probably about 7-8 minutes here. So we'll start to see some of those new options flow. We can see there is interest building in higher prices. 68.20 also getting a decent size offer just above. And you could see that layering starting to pick up. That just tells you there is interest in higher prices, and then the key becomes, how do we react to some of these zones of offered liquidity? So those morning buyers will not be deterred. And I think a good sign that we could see this morning was that test below the point of control was immediately and aggressively bid up. We even saw some passive iceberg buying as that dip was happening. So those sellers were pretty well absorbed by buyers coming in, stepping in to buy that dip. But now we're starting to see buyers get a little bit deterred by this offered liquidity overhead. And today is going to be a big, big day for central bank speakers. So we've got the Fed's Williams at 9:55. ECB has two speakers at 10:30 and 10:40. Then we have Trump and Germany's MERS meeting at a quarter after 11. Fed's Kashkari at 11:45. Trump, Bessett, and Wright. There's going to be several Trump policy meetings from 2 p.m., 3 p.m., and 5 p.m. So kind of a busy day. You could get some crazy headlines out of some of this stuff. I know the central bank guys are probably going to be showing even more caution about any rate cuts now. With the what's happening with the geopolitical tensions, with the potential of knock-on price effects with oil rising, less and less likely that we're gonna get Fed cuts anytime soon. And then if Trump's pick, Warsh, is actually confirmed, he appears to be quite a bit more hawkish than what the market was pricing in. So you're already seeing Fed funds reprice what the rate cutting cycle may be. And buyers rejected that overhead liquidity offers, and we are now right back to the point of control. Tension building. And we are breaking below the point of control. We're seeing a small stop run on that break. And we're starting to see interest build in lower prices as these bids start to stack up. 67.60, 67.50, 40. And the heat map turning even more red. Energy starting to give back some of those early gains. Really only ConocoPhillips bid here by about 0.6%. Costco still bid by about 0.8%. Target's up 5%. Best Buy's up 6%. I know the retail earnings are starting to flow through, so I imagine that's related to some of these. But overall, it is a pretty distributive day. And again, only 10% advancers versus 84.4% decliners across all US listed equities. If we crack key 4 to the downside and build some acceptance, that whole initial move looks like it was just a fake out. And we are getting more headlines about escalations in the Middle East coming through now. Back and forth in Lebanon between Israel and Hezbollah, Hezbollah being a terroristic group that is funded by Tehran, that has its proxy apparatus in Lebanon as well. So there's escalations there, the regional conflicts escalating. And the Israeli military issuing an evacuation warning for another area in Tehran, indicating an immediate strike, and Tehran's airport hit by strikes, according to the Iranian news agency. So really no signs of de-escalation. There was some talk yesterday, different Gulf allies saying that they wanted to try to de-escalate. There were rumors that Iran was also trying to figure out a path towards de-escalation, but it does not seem like that is on the menu today. We see another stop run playing out here, a small one, but another interesting note is a change of character from the passive side of trading. 995 contracts sold and an iceberg sell here below the point of control. So remember earlier, we saw some buying below the point of control by passive. Now we're seeing selling below. And we are pushing below key 4 as we see some of this liquidity stack below at these bids. It's going to be all about whether that causes us to reject those bids and maybe bounce back to the point of control. If we accept those bids and start to see sellers actually absorb that, that is pretty basic. It's telling you they have plenty of supply to keep pushing lower based on auction theory. And we are pretty close to seeing some of these flows come through this morning as well, so I'll be keeping an eye on that. We are deep in negative gamma territory as well, and what that means is that sells tend to feed on themselves. You have dealers that will sell into dips that will buy into rips, so it's a volatility catalyst. C Limited, which is was one of the darlings of FinTwit for a while, down 23% here as it misses EPS. That symbol SE. MongoDB down 25%. Credo Technology, a semiconductor, down 14%. On. A footwear company down 11%. A lot of companies having profoundly negative reactions to misses on earnings or other bad news. It's a market that's not very patient. And that makes sense given that parts of the market have been priced to perfection. Blackstone down 8% today, hearing about more redemptions from some of their private credit funds. And so far, sellers not able to make that push below that offered liquidity on bid, but they may get another chance. Neither side seems to have a ton of conviction post open. Buyers gave it a shot. Now sellers are giving it a shot. The good news about all this, though, is it gives us a really big opening range. So probably going to be a pretty dynamic trading day overall. You can see some of that put flow coming in just around where we are presently. Call flow coming in quite a bit above. We'll keep an eye on that as it develops. It's still a bit early yet. But right now, seeing about 812 contracts at the 69.50 strike for call flow and 472 contracts of puts flowing into 6,700. So that's a pretty wide range. In fact, between the top hot strike and the bottom warm strike, there's a 300-point spread of SPX points. So we'll see how that evolves. That should narrow as time goes on, but I'm imagining there's a decent amount of hedging flow going on in the indices. There has been for weeks now, hedging in the indices, folks getting a little less comfortable, a little less complacent with all the risks that we're building. So some of the larger desks were certainly hedging for downside into this. It's probably one reason why the downside isn't more pronounced. And yeah, we are seeing sellers get another shot to chomp at this liquidity. Let's just zoom in a little bit more so we can see this. We are pushing below key 4 negative as well. That's not a great sign. S&P now down 2%. We are starting to absorb some of that liquidity below. So sellers are telling us they've got the supply to keep pushing while buyers are being stopped out on some of these moves lower. Sellers certainly enjoying a momentum advantage across both the intraday time frame and now on the intermediate term time frame as we break below that trading range in the S&P. And hearing Russian grain trade with Iran through the Black Sea and Caspian Sea has stalled after U.S.-Israeli strikes. We could start to see some humanitarian issues emerge as well with everything going on. And for S&P 500, worth watching 6742.75. That's a major pivot that should offer some support below. That's 6742.75. And put flow is picking up markedly here. We've got 5,000 chasing the 6,700 strike on SPX. That is the hot put or the most active strike. That would infer S&P 500 futures for March at 6708.75. So there's a lot of demand down there, just about it's about 40 points lower. You can see that starting to show up on the chart. We'll zoom out a little bit. That is also a put wall zone, so that's another area of support to watch that could be pretty formidable, just around 6708.75 on ES. So massive, I'm watching gold. I am watching gold. Talked about it a little bit earlier. It is slipping further. Silver's down 9.24%, so we're breaking below that trend line. So that's looking pretty bad for silver, and gold similarly down pretty heavily, now down about 4%. That would take gold back to the 20-day moving average. That is an area of support worth watching on gold. The 50-day is the big one, though. So if gold keeps slipping, watch the 50-day for support. If it breaks that, that's where I'd start to become more concerned about upside momentum. Silver, on the other hand, has a pretty bearish look. Not only is it down 10%, it's got the 20-day crossing below the 50-day moving average, putting in a lower high. You've got West Texas Intermediate crude now up 8%. The dollar is up 1%. VIX up 9.64%. You've got platinum down 10.84%, silver down 9.24%, palladium down 7.38%, and Japan's Nikkei closing down 6.39% last night. Bitcoin also wouldn't want to miss the struggle bus, down almost 4% today. And the Aussie dollar, a commodity currency, after having such a incredible run this year, is now down 1.62% on the day. Trump signaling he's open to supporting armed militias in Iran. So there's nothing here that sounds like de-escalation is on the menu anytime soon. Looks like the goal here is regime change, and those types of situations do tend to get a bit sloppy. And that put flow is continuing to build down at these lower strikes. This is between the two lower strikes, that's 20,000 contracts that's traded hands in the SPX, targeting around 6,700 and 6,705 versus the call side just 8,000. So there's a lot more interest in these lower prices based on the put flow. Now we're seeing the Fed's Williams commentary start to come through, which I don't imagine is going to have as big of a market moving impact as all these geopolitical headlines, but it's still worth watching. He's saying that there's no major secondary impact from tariffs, that the economy is on solid footing, the job market is stabilizing, and that recent data on inflation has been reassuring. And now we're starting to see call flow pick up quite a bit in the last 5 minutes. Now about 18,000 for the two most active calls versus 21,000 for the two most active puts. So we have the midpoint on screen now as that flow is starting to balance out. So overall, this does feel like a heavy market. While we could recover off today's lows, I do think we ultimately resolve that broader trading range to the downside. The risks are building. There's still this rotation underway, and the biggest weights in the market are the losers in this rotation, which suggests there's additional gravity that could pull these indices to lower levels. But I don't think that's a bad thing. Make a shopping list, research companies you want to own at potentially lower prices, and look for the beneficiaries of these rotations. For every situation like this, when there's a discounting in play, it presents opportunities, and that's something that we should, as traders and investors, endeavor to capitalize on. Similar with what's going on with gold and silver, with long enough time horizons, there are buying opportunities that are going to emerge in this washout. Platinum now down over 12% today. And so far, the S&P 500 hovering over this offered bid just around 67.40, but looking a bit heavier. Every time the buyers try to make a push, you can see sellers step in and really erase all that progress and then some. We do have a decent area of support. My major pivot is down here at 67.42.75. That, as well as this put wall, those should both be pretty strong areas of support. I'd be kind of surprised if we break below the put wall today without some other exogenous geopolitical risk-off catalyst coming in. We can see sellers trying to make another push into this area of offered liquidity. Once again, buyers attempting to defend, but not gaining much ground. Good morning, Matt. And we're right down to that major pivot right now, seeing a little bit of a bounce off that area. Again, that's 67.42.75. And you can see liquidity building below, more interest in lower prices. Certainly worth watching this market. It feels quite heavy to me overall. Now, folks, if you want to learn more about my work, visit marketsandmayhem.com. Check out traderaid.com/bookmap and scroll down to the special offers if you want to get up to 40% off Bookmap. I'll be back next week for the next episode of Back to the Futures with me, Markets and Mayhem. As always, appreciate everyone tuning in, and you can rewatch this on the Bookmap YouTube and on my YouTube, and I'll probably edit out some of the intro chart stuff so that I can share that with you all later in its own video. But thanks again for tuning in. I'll be back next week. Catch you soon.